Welcome to the Second Act Investor Education Channel, where we make investing clearer, calmer, and more actionable. Hi, I'm David. I've spent over 30 years in financial services, working alongside traders and wealth management teams. Now I'm sharing what I've learned so you can build a strategy you understand and actually stick with. Quick question. When the market drops, do you have a plan or do you have a feeling? If you've ever found yourself doom-scrolling headlines, watching your portfolio bounce around and thinking, should I sell? Should I buy? Should I change everything? This video is for you. Today we're talking about one of the most underrated tools in personal finance, the Investor Policy Statement, or IPS. Think of it as your personal investing operating system, a short document that tells you what to do before emotions show up. An IPS is a clear, written set of rules for how you invest. It's not meant to be fancy. It's meant to be followable, especially during stressful markets. What an IPS does: it defines your goal, your timeline, and what success looks like. It sets your target mix of growth, income, and stability assets. It tells you how you'll rebalance and what you'll never do. It creates guardrails so you don't improvise under pressure. What an IPS is not. It's not a prediction about the market. It's not a list of hot stock picks. It's not something you rewrite every time you feel anxious. Here's the big idea. Your future is built more by consistency than by cleverness. The IPS protects your consistency. If you're wondering, okay, what do I actually write? Here's a simple structure you can copy and make your own. And I want you to hear this. An IPS is not a homework assignment. It's a stress-proof note to your future self. Keep it to one page if you can, because the goal is to follow it, not admire it. 1. Mission. Why are you investing? What's the job of this portfolio? Example, build long-term wealth for retirement, or create reliable cash flow, or reach financial independence without taking reckless risk. 2. Allocation. Your targets for growth, income, and stability. This is where you decide the mix that matches your timeline and your ability to stay calm. When markets get bumpy, your allocation is the difference between I expected this and I didn't sign up for this. 3. Rules. Rebalancing, contributions, and your never-do list. This is the autopilot section. When you add money, when you rebalance, and what behaviors are off-limits. Rules reduce decision fatigue. You don't have to figure it out every month. You just run the plan. 4. Change control. When you're allowed to change the plan, hint, not because of headlines. Write down the few reasons you'll adjust your strategy. Things like a major life event, retirement timing, or a change in account rules. Everything else? Noise. Next, I'll share 3 sample IPS snippets. 3 different life stages. These aren't the right answer. They're examples of what clear, specific, and followable IPS language sounds like. Disclaimer: I'm not a financial advisor, and nothing here is financial advice. I'm simply sharing my personal journey, the mistakes, the lessons, and the systems I've used to rebuild my second act. Investing always involves risk, and past performance never guarantees future results. If you need personalized guidance, reach out to a certified financial professional who can help you build a plan tailored to your situation. Now let's get back to learning. Profile 1. New investor. 20s to 30s, long horizon, wants simplicity. Mission. Build long-term wealth for retirement through diversified, low-cost investing. Allocation. Based on a fidelity-style model, 85% growth and 15% stability/income. Note, income is optional. Your main income engine is your career right now. Rebalancing. Quarterly check. Rebalance only if a sleeve drifts more than 5% from target. Never do. Day trade, use margin, chase social media pics. For illustration purposes only, your portfolio could be a broad market ETF like SPYM or VTI. Pick one. 42%. A growth ETF like SCHG or VUG. Pick one. 43%. And a dividend ETF like SCHD or DGRO. Pick one. 15%. This could be your AI-verified 3-fund portfolio. According to the Dividend Calculator channel, the 10-year total returns as of March 20th, 2026 are SPYM, formerly SPLG, 304.72%, VTI, 282.26%, SCHG, 383.26%, VUG, 358.58%, SCHD, 233.89%, DGRO, 244.57%. Here's what this profile is really saying and why it works. The mission keeps the goal simple. You're building long-term retirement wealth, so you don't need constant action. You need consistent exposure to broad markets at low cost. The allocation is aggressive on purpose. With decades ahead, the job of the portfolio is growth, and the small stability slice is there to help you stay invested when things get rough. That optional income slice is a reminder that, early on, your paycheck is your primary income engine, so the portfolio can focus on compounding. The rebalancing rule prevents two common mistakes: checking too often and making tiny emotional tweaks. A quarterly check is enough, and that 5% drift trigger means you only act when it actually matters, buying what's down and trimming what's run up. The never do list protects you from the three biggest derailers for new investors: speed, leverage, and hype. No day trading, no margin, no chasing social media pics. In other words, you're not trying to win today. You're building a plan you can follow for the next 20 or 30 years. Profile 2. Mid-career investor. 40s to 50s. Multiple accounts. Balancing growth plus stability. Mission. Reach financial independence while protecting against major drawdowns that could derail the plan. Allocation. 60% growth / 20% income / 20% stability. Engine map. 401k equals core. Roth equals growth tilt. Traditional IRA equals income engine. Taxable equals flexibility plus tax efficiency. Cash equals stability. Change control. I change the strategy only for life events, plan rule changes, or if the plan becomes unfollowable. Fidelity recommends a moderate to growth allocation for investors in their 40s to 50s, typically around 60 to 80% stocks and 20 to 40% bonds / cash. This reflects a shift from aggressive growth toward capital preservation, while still allowing for compounding over a 10 to 20-year horizon. For illustration purposes only, your portfolio could be a broad market ETF like SPYM or VTI, pick one, 40%. A growth ETF like SCHG or VUG, pick one, 30%. And a dividend ETF like SCHD or DGRO, pick one, 30%. This could be your AI-verified 3-fund portfolio. This is the Busy Life IPS. Multiple accounts, multiple goals, limited time. The engine map is huge because it reduces decision fatigue. You're not guessing where to put each dollar. You already decided. And that change control line? That's emotional protection. It says, I'm allowed to adapt, but I'm not allowed to panic. Profile 3. Pre-retiree, late 50s to 60s, designing a cash flow plan. Mission. Transition from accumulation to a durable withdrawal plan that reduces sequence of returns risk. Allocation. 50 to 60% stocks / 40 to 50% fixed income. Example only. Match to your risk tolerance. Stability sleeve rule. Maintain 18 to 36 months of planned withdrawals in stability assets to avoid selling growth during drawdowns. Withdrawal rule. In down years, draw from stability/income first. Reduce discretionary spending before selling growth assets. Vanguard recommends a more conservative allocation for investors in their 50s to 60s, typically around 50 to 60% stocks and 40 to 50% bonds, with increasing exposure to TIPS and international diversification. Their glide path emphasizes inflation protection and reduced volatility as retirement nears. For illustration purposes only, your portfolio could be 40 to 60% in a broad market ETF such as SPYM or VTI, pick one, 20 to 30% in a dividend ETF such as SCHD or VYM, pick one, 10 to 20% in a fixed income ETF such as SGOV or BILS. This could be your AI-verified 3-fund portfolio. Note, this allocation does not include your high-yield savings account. This profile is all about durability. When you're near retirement, the order of returns matters more. These rules create breathing room, so you don't have to sell growth assets at the worst possible time. It's not about eliminating risk. It's about managing the timing of risk. Now, let's make this practical. The fastest way to draft your IPS is to start with a profile that's already close to your situation. Then use AI to translate it into something you'll actually follow. Step 1. Copy the profile that best matches your life stage and paste it into your AI tool. Step 2. Use prompts like these. Rewrite this IPS in my own words, using a tone I'll actually follow. Ask me 10 questions to customize this to my accounts, timeline, and risk comfort. Flag what I must verify: account rules, contribution limits, and tax assumptions. And here's the key. AI is great for drafting, organizing, and making your rules clearer, but it can't know your exact accounts, your plan rules, or the latest tax details for your situation. So use it like a co-pilot, and make sure you personally confirm anything that depends on your accounts, contribution limits, and current tax law. Never forget, you're the captain of this ship. The takeaway. If you take one thing from this video, let it be this. Your IPS is how you stay consistent when the market gets loud. Write it short, make it clear, make it realistic, and most importantly, make it something you can follow on a bad day. If you want, reply with your life stage, new investor, mid-career, or pre-retiree, and I'll show you how to turn these snippets into a one-page IPS template you can use. And if this video helped, consider liking, subscribing, and sharing it with someone who needs a calmer plan. And if you want the complete system behind this approach, check out my book, AI Meets Finance: Investing in the Age of Artificial Intelligence, available now on Amazon. The link is in the description. Inside, you'll get the full second act investor framework for using AI to invest, so you can build a strategy you understand, document it clearly, and stick with it through every market cycle. Thank you for your support, and I'll see you in the next video.